While taxes may be the backbone of every single paycheck, it doesn't always have to leave you feeling helpless, especially if you're still under the $500,000 a year mark. We're not talking about shady offshore schemes or billionaire loopholes. Nope, this is all above board, all legal. Think of it as a game of pennies with the IRS. Each move might seem small, but boy, do they add up. So what's on the menu? We're diving into workplace perks you might be missing. We'll crack open some investment strategies that could save you a bundle. Got a home? There's gold in those deductions. And don't even get me started on education tax breaks. Look, we're not trying to dodge taxes entirely. That's a fool's game. But overpaying? That's not for us. By the time we're done, you'll be a pro at keeping more of your hard-earned cash, all with Uncle Sam's blessing. When you're talking about reducing your taxes, you've got to understand that we're talking about legal methods only. There's no magic bullet or secret hack that will eliminate your taxes completely. That kind of privilege is reserved for billionaires with pretty sophisticated offshore business accounts. For the rest of us making under around $500,000 a year, we're focusing on legitimate strategies to minimize our tax burden. Think of it as nickel and diming the IRS legally. These small savings may seem insignificant, but they're really going to add up over time. Remember, our goal isn't to avoid paying taxes altogether, but we want to make sure we're not paying more than we legally owe, right? Let's dive into workplace perks that can soften your tax hit. First up, commuter benefits. In 2024, you can funnel up to $300 a month tax-free into your commute. Trains, subways, buses, even Uber or Lyft, it's all fair game. Don't forget parking. That's a potential $3,600 yearly savings. Not too shabby, right? Now, about those retirement plans. If your employer's offering them, jump on it. We're talking 401ks for the corporate crowd, 403bs for the government and nonprofit folks. Contribute and watch your taxable income shrink while your nest egg grows. It's like magic, but better. It's math. Health savings accounts, or HSAs, are another tax-saving gold mine. Got a high-deductible plan? You can feed this account with pre-tax dollars. Use it for medical expenses, tax-free. It's like a secret passage around the tax man. Don't sleep on flexible spending accounts, FSAs, either. Pre-tax money for healthcare? Yes, please. But watch out for the use-it-or-lose-it rule. Unused funds might vanish at year's end. Plan carefully. Oh, and if you've got kids or dependents, the Dependent Care FSA is your new best friend. Daycare, preschool, nannies, even adult daycare, all payable with pre-tax dollars. It's like a discount on life's necessities. Here's the deal. These benefits are like paying for must-haves with Monopoly money. Your real cash stays in your pocket, away from Uncle Sam's reach. So when open enrollment rolls around, dive in. Maximize these perks. Your future self will thank you, probably with a tropical vacation funded by all those tax savings. So now onto the topic of investments. There are a whole bunch of strategies you can use to minimize your tax liability. Let's start with capital losses. So let's say you've hit some losses in your stock or cryptocurrency investments. First up, make sure to report them. Losses are actually good for tax purposes as they act as deductions. For stocks, on the other hand, you'll receive a 1099-B form that accounts for your losses. For crypto stuff, you normally won't receive a year-end tax form, so you gotta keep track of and report these losses yourself. Next up, let's talk long-term capital gains. Let's say you hold on to a stock or crypto for more than a year before you decide to sell it. This means it's classified as a long-term capital gain. The thing about these are they are taxed at a much lower rate than short-term gains, about half your regular tax rate. In fact, if you're under a certain income threshold, you might even qualify for a 0% tax rate on long-term capital gains. So make sure to check that out. And of course, you gotta review your 1099-B tax form carefully. This form, which you will get from your brokerage account, summarizes all your stock market movement for the year. Make sure to look out for any missing information, especially in the cost basis section. If this is blank, it could appear as if you bought the stock for $0, making your entire sale price look like profit and potentially leading to overpaying taxes. Oh, and also, don't forget about margin interest deductions. If you're trading on margin, the interest you pay is typically tax deductible. This is often listed on your 1099-B form, but a lot of people overlook it because it's not on the cover page. Oh, and of course, let's not forget about the traditional IRA, the classic. Unlike workplace retirement plans like 401ks, you gotta set this up independently. Depending on your situation, you could qualify for a tax deduction for your contributions to a traditional IRA. As of 2024, you're able to contribute up to $6,500 or $7,500 if you're 50 or older. By knowing all these investment-related tax strategies, you could potentially save a pretty significant amount on your taxes while building your wealth. Remember, it's not just about how much your investments earn, but what you get to keep after Uncle Sam takes a cut. Something a lot of people overlook is that you can actually use your own home as a sweet tax-saving vehicle. Let's start with the mortgage interest deduction. If you have a mortgage and choose to itemize your deductions, you're eligible to deduct the interest you paid during the tax year on the first $750,000 of your mortgage principal, or $375,000 for single filers. This applies to either your first or second home. It's worth noting that this limit is set to increase to $1 million in 2025, potentially allowing for even larger deductions in the future. If you would normally work from home, you could possibly be eligible for the home office deduction. This means you can deduct certain expenses associated with using a space in your home that you normally use for working or any other business purposes. However, there are some important house rules you got to keep in mind with this one. First, this deduction is mostly not available to employees. You've got to be a business owner to qualify for it. Second, the space can only be used for working. While the calculation methods can vary, using the simplified method, this deduction is often worth around $1,500, or potentially more depending on the size of your home office and how you'd go about calculating it. And lastly, let's talk about what's known as the minimal rental use rule. So allow me to explain. If you've been renting out your home on platforms like, say, Airbnb, for example, you could possibly benefit from this rule. If you rent out your home for 14 days or less in a year, the income you earn is 100% tax-free. Pretty sweet, right? This is a great way to earn some extra cash without getting it all taxed away from you. Just keep in mind that you got to report this correctly to avoid paying unnecessary amounts. Once you do, you're good to go. These home-rated deductions can add up to a significant tax savings. Whether you're a homeowner, a home-based business owner, or occasionally rent out your property, make sure you're taking full advantage of these deductions. As always, keep detailed records and consult with a tax professional to ensure you're claiming these deductions correctly. We all know it. Education can be expensive, but the good news is the tax code offers different ways to ease this burden. First, let's talk about the student loan interest deduction. If you're one of the millions of Americans with student loan debt, you're able to deduct up to $2,500 of the interest you paid on your student loans from your taxable income. This deduction is available even if you don't itemize, so it is easily accessible. Next, consider using a 529 plan if you're saving for education expenses, whether for your child, someone else, or even yourself. While contributions to a 529 plan don't always provide a federal tax deduction, many states offer tax deductions or credits for contributions. Even if you're in a state that doesn't offer these benefits, 529 plans are still a pretty good way to get some tax-free growth on your investments, as long as these funds are used for qualified education expenses. Lastly, don't let yourself overlook the lifetime learning credit. This credit is worth up to $2,000 and is available for students enrolled in eligible post-secondary education programs, including college and graduate school. Unlike most of the other education credits, there is no limit to the number of years you can claim this credit. So if you're pursuing an advanced degree, it's not a bad option for you to keep an eye on. Just remember, keep those expense records tight and maybe chat with a tax pro. You'll want to squeeze every last drop out of these benefits. Now let's talk family tax credits. Got kids or other dependents? You might be in for a treat. First up, the child tax credit. It's a good one. Up to $2,000 per qualifying dependent under 17. Here's the kicker. $1,600 of that is refundable. No taxes owed? You could still pocket up to $1,600 per kid, but heads up, high rollers. This credit starts to shrink for married couples making over $400,000 and singles over $200,000. Don't forget the child and dependent care credit. Working parents, this one's for you. It helps offset care costs while you're on the job. The amount fluctuates based on your income and care expenses. With just one kid, you might claim 20% to 35% of up to $3,000 in qualifying care costs. 2 or more, that jumps to 20% to 35% of up to $6,000. These credits are gold. Why? They slash your tax bill dollar for dollar. They're not just reducing taxable income like deductions do, which is going to have a pretty serious impact on your tax bill at the end of every year. To snag these credits, you'll need to cough up Social Security numbers for your qualifying dependents on your tax return. And if you're claiming childcare expenses, keep those receipts handy. Bottom line, these family tax credits can save you a bundle. They're designed to ease the financial squeeze of raising kids. Play your cards right and you could be looking at thousands in tax savings each year. Not too shabby, right? Attention entrepreneurs and freelancers. Self-employment comes with its own set of tax advantages and challenges. Let's dive in. If you're running your own business, vehicle expenses are a potential deduction. If you're using your car for business, you've got 2 options: standard mileage rate or actual expenses. Calculate both and choose the one that benefits you most. Don't overlook the qualified business income deduction. It's complex, but it could reduce your taxable income by up to 20%. Definitely worth looking into. Retirement plans are crucial too. As a self-employed individual, you have access to options like SEP IRAs or solo 401ks. These can help you save for the future while potentially lowering your current tax bill. Lastly, stay on top of those quarterly estimated taxes. Missing them can result in penalties from the IRS. It's best to avoid that headache. Remember, being self-employed means you're in charge of your taxes. Stay informed, keep good records, and you'll be in a better position to maximize your deductions and minimize your tax burden. Think you've exhausted all tax savings options? There's more. Let's dig in. Charitable giving can be a win-win. Itemize your deductions, and those donations to qualifying organizations could slash your tax bill. Cash gifts, you can deduct up to 60% of your adjusted gross income. Just don't toss those receipts. The IRS might come knocking to see them. Are your medical expenses piling up? They might be your silver lining. If they exceed 7.5% of your adjusted gross income, you'll become eligible to deduct the excess. This covers a lot: preventative care, surgeries, even dental and vision work. It's a high bar, sure, but for some, it's a game changer. Here's an odd one: gambling losses. Yes, you read that right. If Lady Luck smiled on you and Uncle Sam wants his cut, you can offset those winnings with your losses. Just don't get carried away. You can't deduct more than you won. And keep those records in pristine condition. Don't forget the SALT deduction, state and local taxes. You can deduct up to $10,000 for a combo of property taxes and either income or sales taxes. Married filing separately, it's $5,000 for you. Lastly, if you've gone green at home, Uncle Sam might give you a pat on the back. Solar panels, wind turbines, geothermal heat pumps, these energy-efficient upgrades could all earn you some sweet tax credits too. Remember, not all of these will apply to everyone, but for those who qualify, it could mean serious savings. When in doubt, make sure to chat with a pro. Let's talk strategy, because paying taxes isn't just about April 15th. It's a year-round game. First up, your W-4. If tax season usually means a big bill to you, you're probably under withholding. Tweak those settings. You might see smaller paychecks, but you'll avoid that springtime sticker shock and potential underpayment penalties. After all, you might even score a refund. Now, about those retirement accounts. They're not just for your golden years. They're tax-saving powerhouses. 401ks, 403bs, IRAs, they all reduce your taxable income. For 2023, you can stash up to $22,500 in a 401k or 403b. If you're over 50, you can toss in an extra $7,500. IRAs cap at $6,500 with a $1,000 bonus for the over 50 crowd. Max these out if you can. Your future self will raise a glass to you, and your present self will enjoy a lighter tax load. It's a win-win. Remember, Smart planning isn't about gaming the system, it's about understanding the rules and making them work for you. So keep learning, stay sharp, and don't be afraid to ask for help when you need it. Your bank account will thank you. So we've been on quite a journey. From commuter benefits to gambling losses, we've uncovered a treasure trove of tax-saving tricks. And here's the kicker, it's all legit. But here's the real secret sauce. Tax planning isn't a once-a-year headache. It's a lifestyle. Think about it. A little attention here, a smart move there, and boom, you're potentially saving thousands. It's not about pulling a fast one on Uncle Sam. It's about playing the game with the rules he gave us. So keep those records tight, stay sharp on tax law changes, and hey, when in doubt, call in the pros. And when you've started saving this kind of money, ever wondered how to skyrocket your net worth past 100K? Check it out here.